because this is going to be a long one. By the end of this, you'll understand why the Fed ending QT is a big deal, and why Bitcoin often acts as the first indicator of stress in the system. So, let's start at the beginning. On December 1st, the Federal Reserve announced that it will be ending QT, or quantitative tightening. Now, if you're not familiar with QT, think of it as the opposite of what the Fed was doing during the pandemic when they were buying trillions of dollars in assets to stimulate the economy. That was quantitative easing, or QE. QE basically pumped money into the system, making it easier for banks to lend, for businesses to borrow, and for markets to rise. QT, on the other hand, is the Fed pulling that money back out. It's them shrinking their balance sheet, taking liquidity out of the system, and effectively making money a little less easy to come by. Now, ending QT sounds good on the surface, right? Less tightening, more liquidity returning to the system. But here's the catch. When the Fed decides to stop QT, it's usually a signal that they've noticed something they don't want to say out loud. They're seeing signs subtle, but worrying, that something in the financial system is starting to crack, or at least become fragile.
The Fed isn't going to announce, hey, something's breaking, we're worried about a collapse. No, that would cause panic.
Instead, they frame it as, we're just doing this to be ahead of the curve, so we don't cause a recession. Investors hear that, but deep down, they're skeptical. They know the Fed isn't just ending QT for fun. They are reacting to underlying stress. This is where risk assets come into play. Risk assets are things like stocks, especially high-growth tech stocks like Nvidia and cryptocurrencies like Bitcoin. These are assets that thrive when liquidity is abundant and interest rates are low. But they suffer when the Fed tightens or when investors sense instability. When QT ends, it can actually trigger a sell-off in these risk assets. And here's why. Investors often interpret the Fed's move as a sign of caution. They say to themselves, okay, something might be off here. I'll just sit this one out until things stabilize. Bitcoin, in particular, is fascinating in this context. It's often referred to as the canary in the coal mine of the financial system. Why? Because it reacts first. Unlike stocks, which trade on regular market hours, Bitcoin can be bought and sold 24/7, including weekends. When investors get nervous about broader financial stability, they often sell Bitcoin first because it's easy, fast, and doesn't require waiting for a market to open. It's the first domino to fall, and that's why you'll often see Bitcoin prices move sharply even before the stock market reflects the same anxiety. But it's not just about Bitcoin being easy to sell. The technical charts, the price charts that traders look at, are essentially a reflection of investors' collective psychology. They reflect anticipation, fear, and expectations. When you see Bitcoin dropping or Nvidia taking a hit, that's not random. That's a macro force at work. It's investors anticipating changes in the financial system, processing the news about the Fed ending QT, and acting preemptively. Markets aren't just numbers, they're a living, breathing reflection of collective human behavior and expectations. Let's unpack that a bit more. Imagine you're an investor with exposure to multiple risk assets. You see the Fed is ending QT. You know that means liquidity is coming back slowly. But the reason the Fed is stopping QT is likely because something in the system is weak. That creates uncertainty. Uncertainty is poison for risk assets. Nobody wants to be the first to lose money if something bigger is coming. So investors start pulling back. They sell a little here, a little there. Some move to safer assets like treasuries, cash, or gold. Others simply pause and wait. This collective behavior drives prices down before there's any real problem, purely because people anticipate problems. And here's another nuance. The Fed's communication itself is a signal. Central banks, like the Fed, are masters of messaging. They won't come out and say, "We see fragility, and we're worried about a banking crisis." No, they'll phrase it in terms of stability and foresight. But investors are reading between the lines. The Fed ending QT becomes a coded message. Tread carefully. Something is fragile. That subtle messaging can ripple across the market faster than any official report. Risk assets drop, volatility spikes, and Bitcoin reacts first. It's like a barometer for financial nervousness. Now, let's talk about why this is so important for broader markets. When risk assets sell off, it's not just about individual losses, it can create a feedback loop. Lower prices reduce investor confidence, which reduces spending and investment, which in turn can affect corporate earnings and valuations. If the Fed sees the system getting too fragile, it has to balance between tightening for inflation and easing to prevent collapse. Ending QT is their attempt to thread that needle. They want to provide a little more liquidity without fully reversing policy. But the market doesn't see the nuance. Investors react emotionally, and that drives early movements in assets like Bitcoin. It's also worth noting that Bitcoin is a unique lens because it's global, decentralized, and not tied directly to any government or central bank. That independence is part of why it reacts first. Investors can shift money in and out instantly, and its price reflects a broader, more immediate sentiment about risk. Traditional markets have friction settlement times, trading hours, institutional constraints, so Bitcoin moves first. And in some ways, it gives us an early warning system for stress elsewhere. Now, I want to emphasize something critical. A sell-off in Bitcoin or tech stocks after the Fed ends QT isn't necessarily a disaster. It's a signal, not a verdict. It's a reflection of uncertainty and caution. Savvy investors see these signals and adjust their strategies. They diversify, hedge, or wait for more clarity. The market is a forward-looking mechanism. It discounts future events and expectations. So when Bitcoin drops, it's not because something catastrophic has already happened. It's because the market is anticipating potential fragility. Understanding that mindset is key to navigating these moments. Let's dive even deeper. Think about how money flows in the modern financial system. Banks, institutional investors, hedge funds, retail investors, all of them respond to signals like Fed policy changes. QT in particular, is about reducing liquidity. Less liquidity means higher borrowing costs, tighter credit, and more careful spending. Ending QT injects a bit of relief, but it also signals that the Fed is aware of underlying stresses. Investors who are paying attention understand that the timing and tone of these policy moves matter enormously. They anticipate the impact on leverage, margin positions, and risk appetite across the system. That anticipation is what drives early movements in assets like Bitcoin. And here's a fascinating aspect. The Fed ending QT also interacts with market psychology in ways that are subtle but profound. Investors have memory. They remember the 2008 financial crisis, the dot-com bubble, and the 2020 COVID crash. When they see policy signals like this, even if the economic data looks solid, they remember fragility in the past. Bitcoin, again, is the first mover, but tech stocks, commodities, and even bond markets respond in kind, sometimes days or weeks later. The chain reaction starts with perception, not fundamentals. Now, you might ask, why doesn't the Fed just explain everything to calm investors? The answer is simple. Transparency has limits. If the Fed were fully transparent about fragility, it could cause panic, accelerate selling, and destabilize the system. So they use carefully calibrated language, adjusting rates and balance sheet policies while signaling intent subtly. This interplay between Fed communication, investor psychology, and market mechanics is at the core of why risk assets fluctuate around policy changes like the end of QT. Bitcoin often drops first when liquidity concerns appear, tech stocks follow, and broader indices like the S&P 500 adjust more slowly. Commodities like gold or treasury yields move in response to these shifts, reflecting investor reallocation. Every move tells a story about expectations, caution, and risk appetite. Understanding this story is how you stay ahead, rather than reacting blindly to headlines. To summarize this complex dynamic, the Fed ending QT is a big event. On the surface, it looks like a positive, less tightening, more liquidity. But beneath the surface, it signals caution. Investors pick up on this and start adjusting portfolios, which affects risk assets. Bitcoin moves first because it's liquid, accessible, and global, serving as an early indicator of systemic stress. Price charts reflect not just numbers but collective anticipation and fear. Tech stocks and other risk assets react next. And the entire system becomes a feedback loop where psychology, policy, and markets intertwine. So, what should investors do with this knowledge? First, understand that market reactions to Fed policy are anticipatory, not reactive. Second, recognize the signals from risk assets like Bitcoin. They're telling you what investors are feeling.
Maintain perspective. Sellers in Bitcoin or Nvidia isn't necessarily the start of a collapse. It's a reflection of power and liquidity dynamics.
And finally, always think macro. The interplay between central bank actions, liquidity, investor psychology, and market mechanics drives the financial ecosystem. The more you understand this interplay, the better positioned you are to navigate volatility without panic. In conclusion, the Fed ending QT on December 1st is not just a policy decision. It's a signal, a reflection of caution, and a driver of market dynamics. Risk assets react because investors anticipate potential fragility. Bitcoin moves first because of its liquidity and accessibility, acting as a barometer for market sentiment. By understanding these forces, you can interpret market behavior with clarity, seeing beyond panic and headlines to the underlying macroeconomic currents shaping our financial system. So, keep watching the charts, pay attention to signals from risk assets, and remember, markets move first on anticipation, not reaction.
Bitcoin is telling you something, and if you know how to read it, you can understand where the financial system might be headed before everyone else does.
This is the essence of macro investing, seeing the patterns, interpreting the signals, and staying ahead of the curve.